insiders have been heavily buying dividend stocks over the last few weeks. Today we're going to select a few that we believe to be undervalued. We're going to look at these in a lot more detail. As you can see, the parameters on screen: minimum 100 shares, at least a 20 billion market cap, and insiders having spent at least $500,000 over the last few weeks. With each one of these undervalued dividend stocks, we are going to run them through the valuation model so we do get to our intrinsic value as well as our acceptable buy price given our investor margin of safety, and look at Wall Street's forecast over the next 12 months. Also, just to let you know, we have released our latest free weekly article. If you want to gain access to this as well as all the other articles completely free, do click on that pinned comment below to get instant access. The first stock that we're looking at where insiders have bought over $500,000 worth of this company is L3Harris Technologies, ticker symbol LHX. We can see it is up around 11% over the last 12 months. It is trading at the upper end of the 52-week range with a yield of 2.18% and a forward PE at just under 17. Now, over the last 10 years, if you have been a shareholder, you would be up 195%, excluding dividends reinvested. And we can see here all-time highs sitting around that $267 mark. In terms of dividend safety, well, a score of 80, it does look to be safe. Market cap 40.5 billion, so it is a large cap company. In terms of the key metrics, well, last recession they increased the dividend. They had average growth negative 12.9%, which was in line with the S&P, and they also slightly beat the S&P with a negative 49% recession return, with the S&P coming in at negative 55. Dividend growth quite nice over the longer term. However, more recent period, 1.8%, very low, especially when we advocate on the channel a minimum of 4%. And we can see over the last 5 years and over the last 20 years, nice double-digit dividend increases, hence the disappointment in February 2024. They have also been increasing those dividends for the last 21 years, so they're 4 years away from becoming a dividend aristocrat. Now, in terms of dividend yield theory, for those that are new to the channel, it states that the company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation. We do, however, note the forward PE pretty much sits in line with the 5-year average. And as always, we don't look at any of these models in isolation and conclude towards the end. We also note the industrial sector PE does sit higher at 20.6. Now, in terms of the free cash flow payout, as always, blanket rule below 60%, so they can offer those double-digit increases that we love to see. Pretty much below that every single year over the last 10 years. And what is also nice to note, 2024, they are expecting this to come down. So next February, when they do increase that dividend, I would like to see a much, much higher dividend growth. Now, free cash flow, we do see the inconsistencies over the longer term. Nonetheless, not only has it increased to up to 2023, but 2024, we do see an expected increase to $11.70. Sales growth, as always, steady moderate growth. We want to see 3 to 7%. Very inconsistent over the longer term. In a more positive news, though, the last year double-digit growth of 14% is very nice to see. And we can see over the longer term, they have increased their top line from 4 billion or just under to just under 20 billion in 2023. Now, shares outstanding, I want to see share buybacks. I want to see a lot of that excess cash return to a shareholder pockets. What we do know, over the longer term, they would have diluted your position due to the increase from 107 million to 191. In terms of the ROIC figure then, above 10% is my own preference. It gives me faith that management are able to effectively allocate their capital. The last few years, it hasn't been the greatest. It is around the 10% level. The best year over that period at 9%. So we do see a little disappointment having dropped down to 7% in 2023. But again, not a massive red flag indicator. It isn't too far off our ideal number. Operating margin above 12%. Now we can see, in fact, operational, what we would call inefficiency, as the operating margin has decreased over the longer term. The only thing we would say is that in 2023 it is around that 12% level, so again, no real red flag indicators. And the free cash flow margin, it does deem to be above that 5% level every single year, so again, looking pretty solid as these metrics go. Now, net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization, we do see it pretty much inconsistent. Some years are well above 3, some years significantly lower. 2023 at 3.63 is a little bit of a worry. I want to see it come down below. Nice to note 2024 is expected to be a little bit lower, but still do note it is above 3. And what this effectively signals is one, dividend safety as well as balance sheet strength. Given it isn't too far above 3, no real red flag indicators, but there are a few pointers just to bear in mind if you are an investor or a potential investor in this company. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now on the channel, typically we run through every single one of these models. Today's episode, let's get straight to the intrinsic value, which as we can see arrives at $248. Now with a margin of safety, we use it at 10% and we pretty much use that for companies that meets 3 criteria: a wide moat, strong financial metrics and good forward-looking data. So up to 10%, it is a buy up to $223 based on our estimates and judgments. At 15%, it isn't too far off, around $2 shy. So we would say LHX in today's episode is around a 15% MOS level based on the current trading value. In terms of Wall Street, well, they expect upside of 15%. They see a target of $245 over the next 12 months. And as always, let us know your thoughts about these companies, whether or not you are adding, maybe you're selling, or they are on the watch list. The next undervalued stock where insiders have been buying a significant amount of shares is JB Hunt Transport Services. Now this is up 16% over the last year. We do see it trading in the midpoint or mid to upper end of the 52-week range. The yield is on the lower side at 0.86% with a forward P sitting at just under 26. Now as a shareholder over the last 10 years, you would be up around 172%. Now in terms of dividend safety, well, we have a very safe score of 89, market cap just under 21 billion, a large cap company. Now in terms of those recessionary metrics, while they increased the dividend during the last recession, they had average growth and they also significantly outperformed the S&P with their negative 29% return. Similar to LHX, a very disappointing increase this year, below that 4%. However, over the last 5 years and 10 years, we do see a nice double-digit increase to the dividend. Now, we can also see 19 years of consecutive increases, being they're 6 years away from becoming a dividend aristocrat. Now, in terms of the yield, we can see a sign here of reasonable valuation. The yield pretty much in line with the 5-year average, although we do note the forward P does sit slightly higher than 22.3 and slightly higher than industrials at 20.6. Now, in terms of the free cash flow payout, very inconsistent. Again, we will be able to soon shortly see that they were free cash flow negative, hence the negative 148%. But even before then, very, very inconsistent year on year. Positive to note, 2024 expected at 26%. So similar to LHX, I would like to see a nice dividend increase in 2025. Free cash flow, again, very inconsistent, noting from the negative in 2014 to negative in 2023. More positive for 2024, expected $6.70 of free cash flow per share. Sales growth actually pretty decent, above that 3 to 7% nearly every single year. However, 2023 we do see a large drop to their top line, and also understanding why we are seeing that free cash flow per share, which is negative. Numerically speaking though, they have pretty much doubled their top line from 6.17 billion to 12.8. Shares outstanding, they do share buybacks, although very minimal as we can see here. They have bought back around 14 million shares over the last 10 years. In terms of the ROIC figure, well, we can see very nice double digit every single year. It has decreased over the longer term. Nonetheless, 14% is still very strong and healthy and fairly attractive to investors. In terms of the operating margin, now they don't really reach that 12% that we see as a bare minimum. In fact, it has been coming down, but still the business does look very strong regardless of this margin that we see at 8%. But you can say something to keep an eye on from quarter to quarter and year on year to ensure it doesn't really drop any lower than the 8%. On the free cash flow margin, we do see some years where it is very poor, notably 2018, 2014 and 2023. So this is one essential metric that I would say to keep an eye on if you are a shareholder or if it is one that is on your watch list. Net debt to EBITDA, we can now understand why we have that very safe dividend score. 0.25 in 2023, 0.24 expected next year. They have a very strong and healthy balance sheet. Now, in terms of the valuation of this company, let's get to that intrinsic value. And don't forget, you can grab a copy of this model if you want to get to both the intrinsic value as well as the acceptable buy price of companies in your own portfolio or those on your watch list by clicking on that pinned comment below. Margin of safety at 10%, again, similar to the previous company, only a few dollars shy from this rate, so we do believe it has near enough a 10% MOS level based on the current price of $201. In terms of upside, well, Wall Street essentially having a price which is fairly in line with our intrinsic value, so they do see upside of 10%, indicating that this is a fair buy depending on your investment thesis. The next stock where we see insider buying is Dick's Sporting Goods, ticker symbol DKS. Now this has been on a phenomenal run over the last year, up 64%, trading right now at its all-time highs at $225. And as we can see, over the last 10 years, this stock is up 332%. It does offer a yield of 1.96% and a forward PE of just under 17. In terms of dividend safety, well, a score of 80 indicating it's safe. Market cap 18.5 billion, a large cap company. Now, last recession, they weren't paying a dividend. However, they had above average growth, but they did trail the S&P with their negative 67% recession return. Pretty much as good as it gets in terms of dividend growth, double digits just this month to their dividend, 35% on average over the last 5 years, 23% on average over the last 10 years, so a very, very strong dividend growth company, and they have been increasing those dividends for the last 9 years. In terms of dividend yield theory, well, we can see here a sign of slight overvaluation with the yield sitting at 1.96 and the 5-year of 2.28. We do note the forward P does sit significantly above the 5-year average, and when we compare it, it is slightly higher than consumer discretionary of 15.1. Now, when we draw your attention to the free cash flow payout, we can see it has increased over the longer term. Nonetheless, it is below the 60% I target, but again, if you want to be industry specific and go 40% for consumer retailers, it has been again pretty much below that, although we do note 2025 is expected to climb to 52%, which in my personal opinion doesn't seem like anything to worry about. Free cash flow per share, well, it has increased pretty dramatically if you look at 2020 to 2021 and over the longer term, but do point out that 2025 it is expected to drop down to $8.47. In terms of sales growth, very strong as we see. In fact, pretty higher than the 3 to 7% over the longer term. 2 years back to back of strong double-digit growth, and in the more recent year at 5%, it does sit in the middle of our baseline at 3 to 7%. Numerically speaking, pretty much doubled their top line from just under 7 billion to 13 billion in FY24. And we also know over the longer term, they have done a fair amount of share buybacks, again, essentially increasing your ownership of the company. Now, ROIC above 17%, again, for those that do like to be industry specific, 20% in 2024, looking very attractive for investors. Now, in terms of the margins, we can see not the greatest over the longer period, but we do see in the more recent years, 2022 to 2024, looking healthy, and the same could be said for the free cash flow margin from 2021 to 2024. But again, with this company and similar to essentially a few others, there are some metrics that I would say just to keep an eye on over the next few years. Net debt to EBITDA, phenomenal. In fact, 1.01 in 2024, expected to go lower in 2025, so no issues with their balance sheet. And in all honesty, the dividend, as we can see with the score above, does look to be safe. So let's get to the valuation of this company, and the intrinsic value for today's episode is coming to $256. So margin of safety, we put that 10% level, and we can see a buy up to 231. At 15%, it isn't quite there yet. So for today's episode of DKS, we see between a 10 to 15% MOS level. In terms of Wall Street, well, their price target, $247. They see upside of 10%, indicating they do believe it to be a fair buy over the next year. The next stock with a lot of insider buying, we have Dominion Energy. Now, this is one that is down 10% over the last year. We see it trading in the midpoint of the 52-week range, with the highest yield today at 5.43% and a forward P of 17.19. If you've been holding over the last 10 years, however, you would be down 31%. But again, bear in mind it doesn't include those dividends reinvested. Another safe dividend score sitting at 70, market cap 41 billion, a large cap company. In terms of those recessionary metrics, well, we can see they increased the dividend. They had average growth, and they did in fact outperform the S&P with their negative 34% return. Now, they haven't increased that dividend since 2021, and over the last 5 years, we do see a dividend cut that took place. Over the last 20 years, they have been increasing those dividends in line with inflation. As from the graph above, we can see, in fact, they did cut that dividend in 2020, and they have 0 years of consecutive increases, however, 2 years of paying a dividend without a reduction. In terms of dividend yield theory, then, we can see that sign of undervaluation both on the yield and on the forward PE, and we also note it is slightly higher than the utilities sector PE at 16.1. Now, in terms of looking at the payout, as always with utilities, they are a lot more volatile, so we focus on the earnings. Below 75%, very high in 2023. We are looking for below 75. It is positive to note in 2024 it is coming down, but given it is very high, I would say this is definitely a metric to keep your eye on if you are a shareholder of Dominion Energy. Earnings per share as well, very inconsistent, and in fact it has decreased over the longer term. The only positive to note, as we can see, expected $1.99 to increase to $2.76 in 2024. In terms of their sales growth, again, due to the cyclicality nature of the industry, we're not seeing 3 to 7% every year. Some years of single-digit negative growth, followed by years of double-digit growth. So overall, very cyclical. Bear in mind the type of companies you're investing in or researching, and understand the projections so you can factor that in to your valuation. Sales then, $12.4 billion in 2014, $14.4, and in reality, if you do factor in inflation, the real increases over the longer term are effectively nil. And when we look at these shares outstanding, this is a utilities company. As we can see, they do rely on issuing equity for their growth expenditures, hence why your position would have been diluted over the last 10 years. In terms of ROIC, so for utilities, a little bit different. We don't look at 10% or more, we look at 7.5% or more. Very consistently around the 5% over the last 6 years. Ideally, we would like to see this go up higher to around 7.5%. Operating margin looking very healthy, as we can see here, above that 18% every single year. So not only above 18, but consistently above that. That is definitely a positive to take note of. Now for utilities, the net debt to EBITDA below 5.5. Now as a reminder for those that don't know, this is the number of years it would take the company to pay off all of their debt net of cash on hand. And 2023 at 6.91, very high. We want it significantly lower. Positive to note it is coming down to 6.25, but again, something I would say to consider and note as an investor, or again, if you are someone who has this on your watch list. Now, in terms of the valuation of Dominion Energy, for today's episode, we're getting an intrinsic value of $53. Now, current price at $49, we use a margin of safety of 10%, and we can see, in fact, for today's episode, it doesn't quite reach that. So Dominion Energy, we see between 5 to 10% MOS level. Bear in mind, a lot of people love investing in utilities due to the stability and the fairly high dividend yield. But again, do note, not all essential utility companies will do those increases in line with inflation year on year. So always factor that in, not your MOS level, but also your investment thesis. Now, in terms of Wall Street, their forecast is $53 over the next 12 months, so they see upside of 8%. As always, let us know your thoughts in the comments below with these stocks where insiders have been buying shares of over $500,000 worth, and let us know if you have also been adding as well. Remember, the reason why we have looked at these shares or these companies today is due to the fact of insider buying, and we consider insider buying to be a very bullish signal, as management only buy it for one reason and one reason only, and that is they believe the share price will rise. Now, as always, do your own due diligence. Let us know your thoughts. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And as always, we'll see you on the next one.